Hi everyone, welcome to Value. Today I want to talk about Katapult. This is quite an interesting company, particularly a company in the buy now, pay later space. If you know Affirm, if you know Klarna that are coming onto the markets, you'll probably be just as excited about this one. And if you've ever used Finserv Afterpay, you know exactly what I'm talking about. So this company wants to merge with a SPAC called Finserv. And basically once they merge, they'll have about $1 billion in valuation, though that is based on those terms. If we look at Finserv right now, the share price has gone up 36%, so we're looking at about a 42.5 increase in the $1 billion valuation, because this SPAC started around $10. This SPAC did raise money in November the 5th in 2019. So it's been quite a while since they've actually raised the money. So they've basically been searching for a whole year to be able to find this company. So you probably think these guys have done enough due diligence and they're waiting for the right company and they think this is the right one. Like, I mean, if you wait a year, obviously you're trying to wait for something good. You're not just going for anything. And these guys think they've actually found something incredible. You know, like this guy's got 30 years of experience. He's been with Barclays, Lehman Brothers. He's been part of mergers and acquisitions of, deals adding over $100 billion in valuation. So, this guy potentially knows, what he's looking for, basically. He spent a whole year. He's waited for a very, very long time. And yeah, you'd hope that he's found the right one. I love this financials of this company. Total revenue for 2019 was $60 million for the 9 months, and then it translated to a $9 million loss. Margins were the cost of revenue was $52 million, so the margins weren't great at all. But as we can see with tech, the margins get surprisingly better. So basically, their revenue increased nearly 3 times to $175 million. Cost of revenue 124. And then that translated to a $29 million profit. So they went from a $9 million loss to a $29 million gain in net profit. And that's pretty good. Like, you'd expect that basically as their business continues to increase, the net profits will continue to increase in a very, very nice way. And we can kind of look at this chart here that gives you a good idea of what they expect for the 12 months. They're expecting about $250 million for the 12 months. That would be up from the $92 million that they did last year. And in the next year, they're expecting about $455 million. And then after that, $799 million in 2022. And in 2023, they break that $1 billion barrier and they do $1.1 billion in revenue, which is quite extraordinary, particularly if we're looking at this company and it's looking at about $1 billion in valuation. And in 3 years' time, they expect to do about $1 billion in revenue itself. So you can see the valuation has a lot of room to move, especially in the long term, particularly at the rate these guys are growing at. And I wouldn't even say these numbers are, like kind of optimistic. I think they're very modest in a way, because if you've just grown from 92 million to 250, and then you expect to go from 250 to 445, I think those numbers are very easily doable by this company, particularly what they've produced in the last 12 months. So them moving up this quick, this fast, it's very, very likely. But even then, if we negate the 2022 numbers and 2023, and we just look at the 445 that they expect to achieve next year, that itself would justify the price tag, and actually put a very like the low middle side of the valuation. Like, I'd say there's quite a nice upside for a company like this, particularly in this space currently, where people do find credit very, very useful. So how does their business model work? So basically, there's multiple ways which you can lend off them. So if you go to your shopping cart and then you go, oh, actually I can't pay the normal way because I don't actually have that much money in my bank account, you can do a leasing option. So this company basically does a lease to buy option. So the minute you pay up your lease, you own the item. And there is no late fees, there is no interest rates, because this is a lease, not like a credit contract of any sort. At least that's how they put it, that they're not a credit contract per se. So they so like if you do a $300 lease, you're looking at about $50 a month. And if you continue for that for 12 months, you end up paying $645. So that $645 is including a $45 origination fee that is always included no matter what transaction price you do. But they've got an extra option here that if you pay for 90 days, all you'd pay is $360, which is $45 for the origination fee, and then 5% for the overall purchase price, which if it's $300, it's $15. And here we'll do it for the $700 example. So if I want to buy a $700 item, I've got two options. I can pay over 12 months, which will be $1,445 altogether over that 12-month period, paying $117. Or I could pay that $117 for the next 3 months, and before that 90 days is up, you can pay as much as you like to reduce your bill. And if you can pay all $780 up or before that 90 days is up, then that's all you ever pay. So you can kind of see like it works out so much better if you can pay within 90 days. Whereas if you can't pay for 90 days, the price jumps up significantly. Particularly with this one, particularly if you're looking at double the price. So if we look at $700 and we go, you pay $45 origination fee and then $35 for that 5% fee. Then in a way, it's not too bad if you pay for 90 days, but it's very aggressive if you wait for that 12 months. Which some people will go through that 12 months, but I'll show you another slide where they do a comparison and they still think they're remarkably cheaper. So you might feel like just double the cost for the leasing is quite aggressive, but it's not too aggressive in the scheme of things. So again, with this 1,200, you'd be looking at $200 a month for the next 12 months, and it would add up to $2,445. But if you pay within 90 days, it is basically just 5% off on the $1,200 and a $45 origination fee. So the maximum you pay if you pay for 90 days is $1,305. So hopefully you kind of get your idea around what this is about. That they have two options. You either pay within 90 days the full amount, or you basically pay over a 12-month period of $200. And in here, they kind of do a comparison of how you benefit. So with Katapult's option, that you'd basically, for a $635 fridge, you'd basically be paying $1,323. But if you use the legacy options, which is like the normal financing options when you go to a retail store, they'll charge you a few $100 admin fee up front, and then afterwards they'll charge you a normal interest rate, and it adds up to $1,819, which is basically nearly triple the cost. So if we look at the $639 fridge, and we look at Katapult and we go, okay, actually Katapult isn't that aggressive, not compared to your traditional lender, which is very aggressive. And if you're silly enough to go with your credit card, but in a sense, if you're going with a branch, if you're choosing between a branch and a credit card, the cost seems very similar. So this is assuming your credit card charges a 29.99% interest rate, which would add up to $1,838 over that same period of time. Yeah, so you can kind of see that Katapult, in comparison to to the current traditional options, is still surprisingly cheaper. But if they add the option that if you pay for 90 days, it is going to just be $639 plus the $45 origination fee. and plus the 5%, which would be about $716. So hopefully you get what this company is all about in terms of how they help consumers afford items and where they earn their margin. So I either earned the 5% plus a $45 origination fee, or basically they do a longer term lease of 12 months, and then basically they charge double the purchase price. And as you can kind of see here, Katapult is okay. Well, I might just have to move my screen so that you can personally actually see that. You can kind of see that it says prime option, so you can kind of see what that's about. So you can see here, Katapult is basically in its own field when it comes to like non-prime credit. So you've got like PayPal, Klarna, Affirm in this online space, and you got like all these other products in the in-store space. But in terms of prime online, Katapult is kind of very, much in its own space, because not very many companies really want to service this non-prime group. And as we kind of looked at Upstart, if you watch my Upstart video, they found 80% of people actually have never defaulted on a credit product before, while the finance industry is focused on your credit score, and hence only 48% would be eligible for prime credit. Whereas if 48% of people are under prime credit, whereas 80% have never defaulted, there's a lot of people missing out on potentially a chance where you can lend money to them, because they're not as risky as you think they are. And here they've done the statistics. So here they've got 1 million prime lender applications. They think about 65% get declined, which will be about 650,000 people that are not being served. And Katapult thinks they would give that 650,000 people, about 60% of them would get approved by them, which would be about 390,000 for every million applicants that would be approved. So that's about a 39% of customers that are not being served properly, where Katapult can actually serve them. And if they do a conversion, if they can actually convert 60% of this 390,000, they would actually get about 195,000 customers. And if they do an average value of $600 to them, for every 1 million application, it's worth 117 million in loans. So yeah, like the case study itself is quite a compelling one. They think they can serve a large group of people because no one else really wants to serve them as much. But of course, there's still competitors. So we have Katapult that serves non-prime, and then you've got Affirm and Afterpay, who are like probably the bigger ones in this space, who do not want to deal with this kind of group of people that don't pay up on time or potentially are high risk. Whereas Katapult is fine, because they're like, oh well, the items you're buying aren't too high in price, and we think you're much better than what these companies actually view you as. Like if 80% have not defaulted on credit products, then potentially the risk profile isn't that as high as people kind of perceive them to be. But you have companies like Cecil who do serve them as well. PayPal doesn't, Repay does, Progressive Leasing does. But out of all these companies, obviously the top 4 are the most interesting in this buy now, pay later space. And of course, PayPal is a juggernaut in this area as well. But of course, Afterpay and Affirm are the ones that we're looking at in terms of this space. And Katapult, hence why Katapult's like partnering up with Affirm. Anyone that Affirm's not serving, basically they're left to Katapult. And as it's put, Katapult has some of the best growth rates that they're projecting for the next 2 years, or 3 years, I guess. So in the next 3 years, they're expecting their growth rate to be on average, about 79%. Afterpay is like 52%. Affirm numbers have not been confirmed or affirmed, because they're still filing for their IPO, hence a lot of it's not public. whereas Afterpay and Cecil are public companies on the Australian Stock Exchange. And as you can see with PayPal, their growth rate's around 19% for the next 3 years going forward. So you can kind of see, like, in terms of growth, Katapult is growing much more quicker, and the valuation is much more lower. Like, I'm personally very familiar with Afterpay and Cecil, and the valuations are quite high in the scheme of things. So yeah, like, I personally think Katapult has got so much potential. It's definitely a company worth considering. So yeah, like, in terms of that billion valuation, I can definitely see them going well above 2 to 3 billion within the next 12 or 18 months. Because yeah, like, they're proving a lot. I think a lot of people have yet to see this deal, because this deal basically just came through in the last 2 days. But the share price of Finserv has moved up quite a bit already, but I think it can move up quite a bit going forward as the merger gets closer. If you've got any questions or comments, post below. Until then, thank you for tuning in, and good luck investing, everyone.